Thanks for joining David, Kevin, and myself for the market update for the month of December. I hope everyone had a fantastic Christmas and New Year's. I know we sure did. Markets continued their strong performance. The TSX was up 0.7% in December. 20% for the whole year. The S&P 500 was up 5.73% and 28% if we convert to Canadian dollars. And the MSCI EAFE index was actually down 2.27%, but had a positive return of 3.82% in Canadian dollars for the whole year. I'm going to pass you over to the guys to give you a full update, but again, hope you and your family are doing well, and if any of you need to top up your TFSAs, please let us know. Take care.
So as Harry mentioned, overall 2024 was an exceptional year for the markets, particularly North American stock markets. Kevin, what was driving the markets in 2024?
The first and most notable factor has been artificial intelligence. The AI revolution continues to drive significant gains, particularly in the technology sector, where we see companies that are leveraging this AI technology for innovation and efficiencies see substantial growth. The AI stocks in particular, though they did see notable volatility in 2024, did ultimately provide substantial growth for the markets. A second major factor was the strong U.S. consumer. The resilience of the U.S. consumer was crucial for providing sustained economic growth in the United States. There we saw healthy job creation, wage growth, and consumer spending support corporate earnings and market growth. The third factor was lower inflation and borrowing costs. Throughout 2024, we watched as inflation ticked down, reaching a very manageable rate of 2.6%, all while the Federal Reserve continued to cut interest rates, creating a very favorable environment for borrowing and investing. All of this helped boost investor confidence and support equity markets.
Looking ahead to 2025, we continue to remain optimistic as we think some of the same themes that were present in 2024 will continue to propel the markets forward in 2025. Namely, artificial intelligence isn't going anywhere. It's only going to continue to mature, and more companies will find ways to take advantage of it in their own businesses. And I think the U.S. consumer continues to still be in very strong shape. They're not nearly as impacted from high interest rates as we are here in Canada. So we do expect the U.S. consumer to continue to prop up the markets and the economy heading into 2025. Of course, there are a couple new issues now on the horizon with President-elect Donald Trump coming into power in 2025. He's threatened 25% tariffs across the board against Canada and Mexico. So we'll have to see how that plays out. That is obviously a bit of an issue for us here as Canadians and could be inflationary. Some of the same issues that we've been dealing with the past couple of years, namely inflation and the trajectory of monetary policy in Canada and the U.S., is something that is somewhat uncertain. We do think that interest rates should continue to trend down over the course of the year, and inflation is pretty well under control. But again, these tariffs could prove to be inflationary in 2025. By all measures, 2024 was a spectacular year for the U.S. markets. The last time we've had two back-to-back years of over 20% returns per year was in the late 1990s. In fact, it's only happened 8 times since the end of World War II. So looking at that, one might start to wonder, well, is that a bearish signal for next year? Can the party last forever? And looking back historically, of those 8 times that we've had back-to-back 20% returns or greater in the U.S., the third year, 6 times out of 8, it was a positive year. So that's a 75% win ratio as far as the third year still being positive. And in fact, the average return in those periods of time has been 12.5%. So just because the market's been on a nice tear for the last 2 years and it's been doing well, doesn't necessarily mean that it's going to do poorly next year. In fact, when markets are doing well, they tend to continue doing well until something significant changes in the macroeconomic landscape.
As we start another new year, another item that we wanted to touch on was diversification. We have been seeing a very narrow group of stocks driving market performance the last few years. Concentration within the S&P 500 is nearing historic highs, bearing some resemblance to the market of the 1990s. Historically speaking, Trying to chase past performers has proven to be risky, as we saw in the tech bubble of 1999. During that period, we saw growth stocks soar for a window of time, but ultimately value strategies and diversification prevailed. As an example, if you had been an investor in September of 2000 and invested 100% in the S&P 500, you would have lost 45% over the next 2 years, almost twice the amount that you would have been down in a balanced 60-40 portfolio. After those 2 years, it would have taken the S&P 500 investor 6 years to recover their losses, and would have taken 20 years for them to catch back up to a balanced 60-40 portfolio. And that is just a really good example of showing that diversifying your portfolio and investing for the long term has the best chance at winning.
This is a good reminder that fundamentals ultimately do still matter. Growth stocks can run at elevated valuations for quite some time, but eventually they have to keep delivering amazing results. Otherwise, they will eventually disappoint the market and their stock prices will be reduced accordingly. So it's important not to get too caught up in the speculative fervor that maybe is starting to come back into the marketplace with Bitcoin over $100,000. We're not saying that it's not right to own some of these things, and in fact most of our clients do own a lot of exposure to some of these AI names in their portfolios, even some underlying crypto exposure as well in some of the funds that we have in clients' portfolios. But again, it's all about position sizing. We don't want to have too much of any one portfolio in technology or AI names, or certainly in cryptocurrencies. We're not saying you can't do those things, but they just have to be position sized correctly based on your capacity for taking on financial risk. So as always, if you have any questions, if you'd like to review your portfolio with us heading into this new year, we'd love to hear from you, and we'll talk to you again soon.
Take care.